What's going on, everyone? Welcome back to the channel. In today's video, I'm just going to be going over the types of setups that I like to trade, what I look for in these setups, and why I like each of them. So I have 6 setups that I like to trade: the morning top reversal, morning bottom reversal, extreme move, mean reversion, key level play, double bottom, and double top. So right off the bat, we basically have 3, or actually 4, main setup types. These are just, flipped for bearish and bullish. So it's really 3 to 4, different kind of setups that I actually like to trade. So let's get into what a morning top reversal looks like. So I'm just going to be going over all these on this little whiteboard, and then after I'll try and find an example of all of these, and then just show you guys what that all looks like. So first setup, morning top reversal. So what is a morning top reversal? So let's say 9:30 bell, price is going up steadily, maybe going really fast, really just going up there, and then all of a sudden sellers start coming into the market and we start to trade sideways, maybe pop up a little bit, sellers keep selling, getting aggressive, and then eventually there's not enough buying pressure, not enough bids to prop up the market, and sellers break below the distribution, little sideways movement there, and push price down pretty much to the opening price or way lower. So that is what a morning top reversal is. Morning bottom reversal, what do you think that is? Literally, this just flip-flopped to, the opposite way. So let me just show you guys what that looks like. What is it? Morning bottom reversal. Morning bottom reversal, price just gets slammed out of the gate, just totally slammed, bids just getting crushed, sellers are very, very aggressive, but then all of a sudden, price just starts getting propped up, bids come in, buyers get aggressive, and price trades sideways for a little bit, and then once buyers get aggressive and there's more aggressive buyers than passive sellers, then bam, price starts to reverse, and we'll usually trade up around the opening price, or can be and then just break out of that opening price. So that's for the morning top reversal and morning bottom reversal. And all of these setups can also be found in all of the setups, and after I go over all of them, then I'll show you guys what I mean by that. So then we have extreme move, mean reversion. So let's say some news comes out, ES, dumps 40 points, right? So let's say ES dumps from 43.60 to 43.20. So, boom, price just goes rocketing down, right? If it's down 40 points in 3 minutes, well, again, you'll have to look at some, factors like Bookmap and see where buyers are buying and if they're coming in. And let's say they are, then you might be able to take a quick trade with a very tight stop loss, and probably not full size, probably half size. But if you can catch it somewhere near the bottom and sell, maybe this retraces 50% of that downwards move of 40 points. Now you can catch that little retracement for 20 points, and the 20-point rally could happen in less than 5 minutes, which would be absolutely insane to catch. Now, yes, it can get kind of dangerous if there is a massive sell-off and you're kind of trying to catch a falling knife, and price drops 40 points, and then you buy, maybe it goes up a little bit, and then it's actually just a dead cat bounce. Boom, another 20 points, gets stopped out. So yeah, it's not going to work perfectly, of course. It is kind of dangerous, which is why I said you need to go in with half size. Definitely, I would not go in with full size, especially after a crazy move up or down. I mean, I guess you could go in with full size. You just have to play very, very tight risk management. But just remember that price will be moving around a bunch, and slippage could be a massive issue, even if you're just trading with one contract, because there will probably be a lot lower volume and liquidity at each tick. And yeah, price is just going to be bouncing around a lot. So that's for the extreme move mean reversion. And now we have a key level play. So again, right, let's say price is just doing whatever. Key level of 4,000. That's 4,000. Boom. Price, let's say this is like 40.10. Price comes here. Boom. Trades, breaks, maybe goes down a little bit to 43.96 or something. And then, goes back up. Buyers are all buying at 4,000, getting really, really strong. And now that price has already tapped into that 4,000 level, buyers are all enticed. Sellers don't want to short through that brick wall of 4,000 because there's just going to be a bid wall at 4,000. And yeah, price just, rallies, trickles back up, and just bounces off that key level. So that's a really, really simple play, key level play. I mean, that's mostly what trading is based off of. A lot of it is key levels, and you can use the key level play on the morning top reversal, morning bottom reversal, extreme move mean inversion, double top, or double bottom, right? So is that really a different sort of play? Not really. That's why I said 3 to 4. That's just what I like to see. It would be nice to also have a key level on any of those other setups. But I mean, if there's no real setup, but it is getting to a crazy key level like 4,000, then, that would be a possible trade setup. And now we have double bottoms and double tops. So double top, I did go over this in, I think, the pattern video just a few videos ago. So double bottom, so price trades, price gets slammed, buyers come in, goes back up a little bit, but now sellers get aggressive again. They're trying to short this and break price below that little reversal right here. Price goes back down. Sellers are trying to hammer it below that price. Buyers step in again, push price up. Now a bunch of sellers that are trapped in this zone that are going to get squeezed and stopped out maybe here. Now they're in trouble, so they start covering their short positions, and they have to buy it back. So buying pressure increases, and bulls get more aggressive. They want to squeeze the shorts and break it above here. They want to buy here or here and sell it here, here, or here. And, price breaks there. Shorts start covering, squeezes even more, and there you go. So that's for a double bottom trade setup. And now let's go to a double top, which of course is the same thing, but it is just a bearish setup. So price trades, buyers bidding up the price. We come into a zone where sellers start to sell. Sellers now try to push price back down, but buyers want to, maybe they'll see a bull flag or something and they want to push price over that little reversal level. So bulls come in, they try to break it above, get that breakout. They don't. Sellers get aggressive again, push price back down. Now, again, right, bulls, buyers that bought right there, their stops are probably somewhere around here. And now that selling pressure kicks in. Buyers start selling pretty aggressively, which drags down the price. Sellers start getting short. Boom. Now, buyers' stops are all getting hit. That's flooding the market with sell orders, and price just breaks down. Boom. That is double tops and double bottoms. And that is, you know, for all of the types of setups that I like to trade. Now, let's bring the setup list back here. So a morning top reversal and morning bottom reversal, right? So boom, price goes up, right? It's trading here, trading here, trading here. The funny thing is, it could break down here, retrace a little bit of the move, and then literally just get bid up. Just because price gets bid up, starts moving sideways, does not mean automatically that's a morning top reversal, right? I mean, this is honestly what you would see in a double top, right? Price could come here. It could either break or could do the same thing, you know, not perfectly, right? Could pop up, you know, stop out all the people that are getting short here, and then, and which it usually will, just check the charts, right? So stop out little candle movement right there, move sideways, and then eventually boom, right? And then now you have the double top, which doesn't look so clean, just like that, right? It doesn't look as clean as that, but this is a double top. And this, when you actually look at the charts, this is what you would see for a double top. So that is how, you know, a morning, and again, you could literally put, this is the morning top, so morning top and double top. You could literally have this for morning bottom reversal and double bottom, right? And then, right, you could also have the fact that, let's say this was a key level of 4,500 or something, right? And, you know, kind of would it be an extreme move mean reversion, right? So reverting back to the mean, maybe, you know, this little 50% area to retrace of the move. So, you know, all this stuff, all these setups are all just interchangeable in, you know, each other, right? And that's the whole basis of my strategy, which is supply and demand, right? Where we come into a zone where sellers are getting more aggressive. There's more supply. They're trying to flood the market with, you know, sell orders and a lot more contracts. They don't think price is going to go higher. And neither do bulls, right? Bulls, if they thought that, you know, this is 4,500 and they can go to 4,510, then price would be at 4,510. It might take a while to get to 4,510, but, you know, again, that's the whole basis of the market: supply and demand. Price goes up because there's more of a demand than supply, and price just gets bid up. Bulls think that the S&P contract should be higher than it is right here at, let's say, 4,480 or something, right? And then bears now think that 4,500, all right, I'm good. You know, I think price has gone up high enough. I don't think price should be at 4,510. I don't think it's worth that. So I'm going to get short. I think that, you know, there's not going to be enough demand to fill all the buying orders and, you know, keep bidding up the price, and price is probably going to fall because the market is an auction and it's going to go to whatever price there is interest at. That's why the market moves. Okay. You know, I saw a funny thing the other day, a funny little tweet that was like, the CEO of a company asked me what his stock was going to do, and I said that it's going to go down because XYZ little pattern, and, you know, it saved him $10 billion and, you know, gave me $1 billion because of that. No, guys, it doesn't. The market does not move because of little patterns or little hocus pocus bullshit that you see on the internet about fair value gaps and whatever ICT bullshit there is. No, guys. If there's more buying pressure than selling pressure, more aggressive buyers than passive sellers, the market will move up. If there's more aggressive sellers than passive buyers, the market will move down. That's all we're doing here. All these setups are literally just supply and demand. All right. So that is the little drawing portion of the video. Now let's go hunt for actual chart setups, and I'll show you guys what I look for on the charts. All right, guys. So right here in the right corner of my screen, we have a morning bottom reversal. Not a perfect one, right? But, you know, this is just what it would look like. So price comes down, comes down, comes down to this 43.70 demand level. And, you know, price trades, bottoms out, buyers get more aggressive, start filling all of the selling pressure and all the sell orders. And then you see that sellers, you know, don't want to keep pushing price down and buyers get aggressive. And then boom, price starts rallying and rallying throughout the day. So boom, just right there is an example of a morning bottom reversal. Now here's an example of a extreme move mean reversion. So you see here, I'm guessing we had maybe some news or something. This is probably on like an Apple, Nvidia, Tesla news, just because, you know, it's not at like 2 o'clock or something. So, you know, price gets pushed down 20 points in like 10-ish minutes. So, you know, maybe you could have bought off of VWAP here. Again, it would have been kind of tricky because you could have longed off of 4,400 and thought that was the key level to buy at, and this, you know, price could have kept on reversing. But again, you would have to see just how the market is looking there, and you can use Bookmap for that and just see, you know, the buying pressure. I'll explain what Bookmap is and how to use it in a video a little bit further down the road. But yeah, this is an example of a, you know, extreme move mean reversion trade. So could have bought hopefully between 43.95, 43.90, and then, you know, half size, increase the stop, and then maybe could have caught that reversal back upwards. And a extreme move would look very extreme, basically just a ton of either red or green candles and a very sharp direction and a very sharp drop or pump. So now this is an example of a morning top reversal. So price pumps up from 43.75 to around 4,400, 4,405. Price comes up, goes up, bids up, comes into this 4,405, 4,400 supply level. Sellers start getting aggressive here. You can see buyers try to bid price back up. Sellers pushed it back down, tried to, you know, push price above that. Sellers again pushed price back down. And now, you know, this is the distribution or you know, sideways action, and then price just falls all the way back down. Nice, solid 40-point sell-off right there. So that is an example of a morning top reversal trade. So now right here on NASDAQ, this would be an example of a double bottom. So price goes down, buyers start bidding up the price. They keep trying to bid up the price, but now sellers start stepping in kind of at that 50% mean reversion, and price gets slammed back down kind of into that demand zone that we have here, and then price goes up and up and up and up and breaks out of that 15,140 key level and this 15,140, 15,120 supply level. So this is a pretty decent example of a double bottom. I can't really find a great example of a double top on here. There's really just not a perfect example, or actually perfect right here. So yeah, this still is not the best example of one, but basically just the main key points you need to take away is just if price can't break out, you know, of let's say 15,380 here, if it gets rejected here, you see a lot of selling pressure, then price is probably going to come down. Of course, we could have just traded, came around 15,360, and then, right, buyers could have gotten aggressive again, and then squeezed all the shorts here, and squeezed them like that. That happens all the time, right? So you just have to look for, you know, an increase of aggressive sellers that are stepping in around 15,380 there. And again, trading is not a 100% guaranteed thing. It's just a game of probabilities. So most of the time, and again, it really just depends. You have to build your market intuition. You have to know just what kind of market we're in. Are we trading in a sideways market? Are we in a bearish market, bullish market? If you're in a bullish market, you probably don't want to be shorting a possible breakout. You'd probably want to long this because we would keep going up in a bull market. If we're in a sideways market like we are right now, then yeah, you probably would want to start to short these possible double tops. And if we're in a bearish market, you would definitely want to be shorting the double tops because the probability of price going back down and not breaking out would be higher in a bearish market. So I believe that covers all of the types of setups: morning top reversal, morning bottom reversal, extreme move, key level, double bottom, double top. Yep, I do believe that covers all of it. Maybe not the key level, but basically, if you see right here, 15,300, you can see that we respected that pretty darn well and popped right back up there. Could have made $1,200 on one contract for that 60-point move. So, wow, 20 minutes of recording so far. So I really appreciate you guys watching this video. I think it's very, very informative. If you don't have a set strategy of your own right now, I think that this will definitely help you. You don't have to copy this to a T, but just to get some inspiration. And again, trading is just a game of probabilities. None of these work out perfectly all the time. I just showed you ones that do work. Could easily show you a lot that don't work. And again, it all looks pretty obvious in hindsight, but we easily could have just, formed a bear flag here. Instead of this long green rally, we just keep bidding below 15,300. So yeah, guys, again, just build your market intuition. That's how you're going to be able to just get that little gut feeling that, okay, yeah, it is looking like a day where buyers are going to start stepping in here or sellers are going to start stepping in here. And it takes quite a while to develop that market intuition. But again, that's why I say multiple hours a day should be at the screen, studying the chart, watching the chart super intently, and studying it and internalizing how the market is moving, so that when you do see that, the market came down here and it was a full red candle, but then instantly popped back up. Okay, now I remember, because in the 16 other days in the last 3 months that I've seen that, yeah, that's a 70% chance that we're going to bounce back up. So let me now start to look for a long entry. That's how all of this works. So once again, thank you guys for watching this video, and stay tuned to the next video, because again, that's going to build on this one. See you guys in the next one. Peace.